Hello everyone, welcome to EduTap. I hope each of you are doing good and preparing well for the exams. I welcome you all to the new series of 5 MCQ on finance. Today we'll be discussing 5 MCQ on bonds, which is a very important chapter for RBI Grade B and SEBI Grade A as well. Now, before moving ahead, we at EduTap have a very good news for you. We have brought you a comprehensive guidebook for RBI Grade B, wherein you will get to know everything about the exam, starting from the role of RBI in Indian economy, what is the hierarchy when you get into RBI Grade B, about the roles which are performed by the RBI manager, and not just this, you'll also get to know the detailed pattern of the exam, the various cutoffs prevailing for different phase and interview as well. You will also get the detailed syllabus of each and every phase, which requires a lot of time and consumes a lot of energy. Apart from this, you will get the detailed syllabus of phase 1 and phase 2. And not just that, once you clear RBI Grade B, you will also get to know what is the training process, what is the salary drawn, and what are the various perks and various resources that you as an aspirant can follow. And let me tell you that this guidebook is absolutely free and you can download the same from the link in the description box. Likewise, we have also come up with a comprehensive guidebook of SEBI Grade A as well. Before starting the session, if you are new to our channel, I request you to subscribe to our YouTube channel and join our Telegram group to receive the PDFs of the session. Now, without delaying further, let's begin the session. Now, the chapter bonds is relevant to both RBI Grade B and SEBI Grade A as well. We have seen various questions in phase 2 of RBI and phase 1 and 2 of SEBI Grade A as well. So I guess you like the session and stay throughout. Now let's go to the session quickly. The first question says that which of the following is true about a zero coupon bond? The first option says that they have no payments till maturity but one final payment at maturity. Second, they are issued at a discount of 20% or more. Third, the difference between the purchase price and the face value of the zero coupon bond is the return earned by the investor. So in this question, you have to select the correct statement about zero coupon bonds, and the correct answer to the question is option C, which says that statement 1 and statement 3 are correct. So let us understand what are zero coupon bonds. See, zero coupon bonds, unlike normal bonds which make regular coupon payments throughout the maturity of the bond, do not make coupon payments, but these coupon bonds just pay the face value at the maturity period. So which means you may ask me, why then as an investor I'm going to purchase these bonds? You as an investor can purchase these bonds because these bonds are issued at a discount initially, and at maturity you will be receiving the face value. Let us understand this with an example. Now let's say there is a bond which has a face value of 1000. Face value is nothing but the principal value or the par value which the bond issuer issues at the time of issuing. Now, this bond has a maturity of 10 years and the issue price of the bond is 600, which means initially, let's consider this timeline at t equal to 0 and this is t equal to 10. So, at initiation, you are supposed to pay $600 and at the end of 10 years, you will be receiving $10,000. Now, what do you see in this case? In this case, you see that there is no coupon payment in between, which means there are only two cash outlays. The initial cash outlay, which you as an investor would be investing, and the final cash outlay when the bond is redeemed. So you can ask me, what am I as an investor getting in this case? I am not receiving coupon payments. So the difference between the issue price and the face value is the profit which you as an investor would make. So why do people invest in zero coupon bonds? The biggest reason is for those people who want a fixed sum of money, a certain amount of money at the end of certain period of time. Those kind of people can invest in these types of bonds. Keep in mind that these bonds are always comparatively have a longer duration compared to the normal bonds. मतलब अगर किसी बॉन्ड का 2-3 साल मेच्योरिटी पीरियड है या 4-5 है तो these bonds have a higher maturity period. Now, why statement 2 is wrong? The statement 2 says that these bonds are issued at a discount of 20% or more. This definition is of a deep discount bond. ठीक है? Deep discount bonds are issued at a discount price of 20% or more. Now, you may ask that deep discount bonds are also issued at a discount and zero coupon bonds, and these deep coupon bonds mostly do not pay coupon payments. Then are they same? No. Let me tell you that in very few cases, these deep discount bonds do make coupon payments. ठीक है? They do make coupon payments. And in India, the first deep discount bond was issued by IDBI Bank. Okay, we'll not go into the depth of deep discount bond, and let me tell you, all zero coupon bonds are not deep discount bonds. This is something which is very important and you have to remember. Now let's moving ahead. The second question says that a dash is a bond which provides the investor the right but not the obligation to force the issuer to redeem the bond before maturity. Now, this question is talking about those bonds which have options embedded in them. What are options? Options are derivatives. Again, we'll not go into the depth of derivatives, but the given question says that this type of bond provides the investor. Who is the investor? The bondholder. The right but not the obligation to force the issuer to redeem the bond before maturity. So the answer to this question is B, puttable bonds. Now let us understand what are these types of bonds. As I said you, there are two types of bonds. The first one which do not have options, features embedded, and the second which those bonds which have option features embedded in them. Now, puttable bond is an example of option features. Or puttable bond, what is options? We'll discuss it when we do MCQs on derivatives. But as of now, just understand that a puttable bond allows the investor to ask the issuer to redeem the bond value before maturity. Let us understand this with an example. And please always remember the option features are always mentioned in the bond indenture, which means not all bonds are puttable in nature. If a issuer has to issue a bond which has an option feature embedded in it, he has to mention the same in the bond indenture. So what is a puttable bond? Let's say there is a company A who issues bonds of tenure 7 years maturity period, and it says to its issuers that you can exercise your rights, that is the right to call back, the right of putting, I'm sorry, you can exercise your right after 5 years, which means within 5 years we as an investor cannot exercise this right. We cannot ask the issuer to redeem our money back, but after 5 years we can do so. So now you can simply ask me, why do we exercise such options, ma'am? See, the biggest reason we invest in bonds are the changes in the market interest rates. ठीक है? Let's say after 5 years the interest rate in the market rises. So we as an investor have a normal psychology that we want to invest in those instruments which provide us more return. So now let's say there is another bond B which is providing you a coupon payment of 7%, and let's say this bond was paying you a coupon payment of 5% annually. Okay? So now after 5 years, that now you see that B is providing us with more coupon payment, so we'll start selling this bond, and now as an investor, we'll exercise this right and we'll ask the issuer to redeem our money back. And now the money which we receive will be invested in bond B. So now you can ask, now this seems to be advantageous for the investor, but how about the issuer? So as to protect the issuer, these bonds are issued at lower coupon rates compared to the prevailing coupon rates in the market. Because let's say in future the interest rates rise in the market, in that case the investors can exercise their option. And contrary to the situation, if let's say the interest payments remain unchanged or decreases, then in that case the issuer will not exercise these options. Now puttable bonds, please keep in mind that puttable bonds are also known as retractable bonds. What do you mean by retractable in simple word? As an investor, you can withdraw your funds. That is what simply retractable means. Okay? So, what are puttable bonds? You as an investor can force the issuer to redeem the bond before maturity, but keep in mind after certain period of time. Okay? And these bonds are also known as retractable bonds. So the right option is option B. Now what are callable bonds? Now contrary, or you can say they are just opposite to puttable bonds. Now the callable bond gives the issuer the right to call back the bonds after certain period of time. The puttable bond was giving the investor the right, but the callable bond would give issuer the right to call back these bonds. Why? Might be the interest rates decrease in the market, so he can refinance. Why would he pay extra amount if he can, uh, issue new bonds at a lower rate? This can be a reason. Secondly, let's say the credit rating of the in if the credit rating of the issuer is improved. We have different credit rating agencies in our country, so let's say if the credit rating improves, he can pay less interest rate. So those bonds which are opposite in nature of puttable bonds, which give the advantage to the issuer, are called callable bonds. Now what are perpetual bonds? Perpetual bonds are nothing but those bonds which pay you coupon payments throughout the life. ठीक है? The term perpetuity itself means payments which you receive throughout the life. And what are zero coupon bonds? Again, those bonds which do not make coupon payments, and you get the face value at the end of maturity. Now moving to the next question. Now, this is a numerical on zero coupon bonds. Let me tell you that you are not supposed to get afraid of numericals. ठीक है? See, the numericals of late are not being asked in RBI Grade B, but still I'll suggest you to simply, practice the basic numericals, because whatever numericals which we could see in the previous year question papers were very basic of nature and can be solved simply applying the formulas. ठीक है? So I'll suggest you not to skip the numerical. Now this question says a zero coupon bond has a face value of 1000 and a maturity of 5 years. So what is the face value, par value or principal? It has a maturity of 5 years. The required yield. What is yield? The return. ठीक है? In simple words, the return is 6%. Then in this scenario, we need to calculate the price of the bond. Keep in mind the price of zero coupon bond. The answer to this question is option A, and let's see how do we solve this numerical. Now, the price of zero coupon bond is calculated simply dividing the value which you would be receiving at maturity. Zero coupon bonds में क्या मिलता है maturity में? Face value or the principal. Zero coupon bonds में there are no coupon. ठीक है, they are issued at a discount, ठीक है, and they have a long term period of maturity. I hope you remember all this. And now, how can you calculate the price of a zero coupon bond? You simply divide the principal or the price you will be receiving at maturity divided by 1 plus the interest rate requirements whole to the power n. N is nothing but the number of years till maturity. ठीक है? Now in this question, the given maturity, the given face value which you would receive at maturity is 1000. The interest rate is 6%, which is 0.06, and the number of years is 5. Assume that you are getting, there is no compounding, it is a annual basis pay you will get this return. So in that case, the price becomes to be 747.25. You simply divide 1000, which becomes the face value, and this is 1 plus the required rate of return whole to the power n, which is nothing but the number of years until maturity. Simple है, बस एक formula लगा के you could solve this question. So do not leave such questions. Moving ahead, there is another numerical on YTM. This is a very important concept in case of a bond. Let us read the question. Mr. Murthy has a 7% coupon bond that has a face value of 1000, has a coupon of 7%, and has a maturity of 10 years. ठीक है? If the bond makes annual payments, which means the coupon payments Mr. Murthy is receiving would be annually, the current market price or the selling price, current price का क्या, market में bond किस value पे trade कर रही है, the current selling price of the bond is 861.20, then what is YTM of the bond? Now, before solving this numerical, let us understand what is yield to maturity. ठीक है? Yield to maturity has two terms. The first term is yield and the second term is maturity. ठीक है? What is yield? The returns which you get as an investor for a particular year becomes your yield, and maturity is the tenure या समझ लो कि the number of years जहाँ तक bond, जब तक bond will be redeemed. मतलब let's say in this case 10 year was the maturity. इसका वही मतलब है simply कि after 10 years, at the end of 10 years, your face value will be redeemed. ठीक है? Now, when you club these two terms, you get yield to maturity. What is yield to maturity then? Yield to maturity is nothing but the returns you as an investor would be receiving if you hold the bond till maturity. So in this case, what returns Mr. Murthy would get if he holds this bond till maturity, that is at the end of 10 years. तो आप पूछ सकते हो मैम फिर yield और yield to maturity सेम है क्या, which means is yield current yield, है ना, is current yield and yield to maturity same? नहीं. You always need to keep in mind that YTM plays a very important role in telling you the exact return which we as an investor get. Current yields do not tell us this. Why? What is the formula of current yield? The coupon payments you receive divided by the market price of the bond. So, and this is for 1 year, ठीक है? And this formula does not consider the price differences. Chalo, we as an investor could have bought this bond at discount. We could have bought this bond at premium. So we need to consider all that fact because वो भी तो एक savings है ना हमारे लिए. So YTM, what is the biggest differentiation between YTM and current yield? That YTM considers time value of money. It is going to discount all the future cash flows which you as an investor are going to receive today. ठीक है? And YTM is also known as internal rate of return. What is internal rate of return? Nothing but the value which makes the future payments of cash flows which equates ना, ऐसे समझो ना, simply ये वो value है जो फ्यूचर पेमेंट्स के कैश फ्लोज के प्रेजेंट वैल्यू को इक्वेट करती है विथ योर करंट मार्केट प्राइस. So that is why it is known as internal rate of return. So in case of current yield does not consider, or it doesn't discount the future value of the cash flows, but YTM does that. Now we'll solve the numerical. The correct answer to this question is option A. Let's see how do we solve this. Now, as I said, your yield to maturity is the total return anticipated on the bond if the bond is held until maturity. Now, YTM is calculated using a very simple formula, which is the coupon interest payments plus the face value minus the market price divided by n. ठीक है? That is number of years. Now this whole term would be divided by face value plus market value divided by 2. ठीक है? So let us put this value in this formula. So what is the coupon payment? The coupon payment was 7%. And please remember, you receive coupon payments on the face value of the bond and not the market value of the bond. What was the face value? 1000. What becomes your coupon payment? 70. So 70 plus the face value. What will be the face value? The value which you will be receiving at maturity, subtracted by the current market price. What is the current market price? The price at which Mr. Murthy bought the bond, divided by the number of years left till maturity is 10. Now you divide this whole term by the summation of face value and market value divided by 2, and the answer turns out to be 9.013%. See, I guess you just understand how simple numericals are, so do not get afraid of numericals and do solve them in the exams if they are asked. And let me tell you a very important assumption which you should know. Okay? In case of yield to maturity, we assume that the interest payments which we receive, okay, are reinvested. Please remember, are reinvested at the same rate as YTM. Okay? This is a very important assumption which you should remember. Now moving to the last question. This is a conceptual question which says that if the interest rate of a bond becomes more than the available interest rates in the market, then which of the following statement is or are true? What would be the price of the bond? The question simply says कि एक bond है जो market interest से ज़्यादा interest rate देता है, तो what would be the price of the bond? The option says the price of the bond would increase. Second option says the price of the bond would decrease. The third option says that the price of the bond remain unchanged. The fourth option says the price of the bond becomes half, and none of the above. The correct answer to the question is option A. The price of the bond would increase. Now, let us understand why are bond prices and the interest rate in the market are inversely related. ठीक है? Each of us know this, that the bond price and the interest rates are inversely related, but ऐसा होता क्यों है? See, everything depends on the consumer psychology. इस concept से याद रखना कि there is always a factor of demand and supply. So let's say there was a bond A, ठीक है, which paid you a coupon payment, or the interest payments which you received was 6%. Now let's say the market interest rates which are prevailing right now in the market changed suddenly and the interest rates dropped to 5%. ठीक है? So now the new bonds issued would provide you an interest rate of 5%. Lekin this bond A which was issued earlier is still paying you 6% interest rate. तो एज अ इन्वेस्टर हमारी क्या साइकोलॉजी होती है कि वेन एवर investment provides us more returns, we tend to invest our money in those kinds of funds. So what would happen? People would start selling this bond Bond B, which provides low interest rate, and people will start buying this bonds which provides you high interest rate. So you are not the only investor who is doing so. There are many investors who will be doing the same process. तो अब क्या होता है, when lot number of people start buying these bonds, the price of this bond would naturally increase, है ना. मतलब नॉर्मली सोचो ना कि अगर किसी सामान का डिमांड ज़्यादा है तो क्या होगा, उस सामान का भाव बढ़ जाएगा. द प्राइस ऑफ दिस बॉन्ड वुड इंक्रीज. सो द करेक्ट आंसर इन दिस क्वेश्चन इज द प्राइस ऑफ द बॉन्ड वुड इंक्रीज. सो व्हाट कैन यू कंक्लूड सिंपली? Now if the interest rates in the market increase, then the bonds which were providing lesser interest previously, उनके प्राइस क्या हो जाएंगे, गिर जाएंगे. एंड वाइस वर्सा, अगर मार्केट में इंटरेस्ट रेट गिर गया है और अगर कोई बॉन्ड ऐसा है जो आपको ज़्यादा इंटरेस्ट दे रहा है, तो उस बॉन्ड की प्राइस सिंपली बढ़ जाएगी. आई होप यू एंजॉयड द सेशन. थैंक यू.